This week, Ben and I are going to be digesting some USDA reports on acreage and grain stocks, and then looking maybe at some managed money functions within the market. Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how's it going?
I'm doing all right. I've got a little bit of congestion this morning, as maybe our listeners can tell, but I'm hanging in there. What about yourself?
I'm doing all right, just having a good time down here. But no, Ben, you need to go to like a really smoky bar room and just do an open mic session as a blues singer or something. I think you do really well.
Yeah, my voice is like a whole octave lower, I think, right now. So
Fun stuff.
it'll be fine. Real quick on sports, we haven't talked about sports in a long time, but my Royals got a really key win this weekend against the Cleveland Guardians. So I know we have some listeners in Ohio, and I just want to take that and just leave that out there for interpretation.
Well, it's we finally hit the halfway point in the season, so there's a lot of ball left to be played. So you got to watch out. The Royals could sneak back into first place in the division when it's all said and done. So.
All you got to do is make the playoffs and get hot in September. That's all you got to do.
Yeah. But anyway, talking about things dropping an octave, the markets had a downturn in a lot of different areas, but did find some support within wheat. So a quick rundown here. September corn contracts were down 26 cents at 407. Corn for December down 31 cents at 420. Soybeans for September down 23 cents at 1107. November soybeans down 19 cents at 1111. Soybean oil on a cents per pound basis for September up 2.13 cents at 45.98. Soybean meal by the short ton for September were 1460 lower at 334.80. And then that September wheat crop was up 19 cents at 590. July wheat for 2025 up 15 cents at 641. And then that West Texas Intermediate crude oil contract for September up $1.45 at 82.39. So Ben, some support coming back into the wheat side just a little bit there, and then some moderate to light losses on corn and soybeans. What's your general takeaway as you kind of see where the market is in this shortened holiday week?
Yeah, so let's focus on that feed grade market. So the corn and wheat contracts there. I liked the way the corn market finished on Friday after dropping sharply due to the bearish USDA reports. The corn market kind of came off its lows by about 10 cents. And then on Monday of this week, I was curious to see if that September corn contract would fall below $4. Not only did it not fall below $4, but it finished at basically where it opened for the day. So at the top end of the trading range for the day. And I think I could say the same thing for the wheat complexes. Basically, prices have fallen low enough that we're now getting some bargain buying, where some end users are finding value at buying at these levels. And so I think that's kind of helping place a little bit of a floor under that feed grain market here in the short run.
So looking kind of further out and digesting some of the things that we got last week, USDA released a pair of reports that had some sway. So looking at both the grain stocks report and a June acreage report coming out of USDA, which one do you think between the two might have been more impactful? I know it might be kind of hard to split the two, but looking at that, we saw grain stocks up year over year for corn, soybeans, and wheat. So that might add a little bit of cushion back into the market. So I don't know what your takeaway is there.
Yeah, so the question about which one was more impactful is a hard question to answer. I'm going to answer that by saying the grain stocks report, the June 1 grain stocks report, and I'll explain why I think that one was maybe more impactful. Is when we look at those corn stock numbers, or at least what was reported to USDA by farmers and even commercial grain companies, those corn stock numbers came in almost 900 million bushels higher year over year, and 120 million bushels more than what the trade was expecting heading into the day. Now, a couple of things that strike me as the reason I think it's impactful is, one, given that big of a surprise in the June report, there's two options here. One, either the size of last year's crop was underestimated, that record crop was underestimated and was possibly bigger than what we realized. Or what I think maybe is a little bit more likely of a scenario is we didn't feed as much corn in the last quarter as what we maybe had thought. And a reminder, feed use is always the hardest one to kind of, estimate. And so to me, that stands out as being pretty impactful because we know that our grain consuming animals have declined. The cattle herd has gotten smaller. And we've seen some various factors in the other livestock categories. But that signals to me that USDA is going to have to revise lower their corn used for feed estimate for the current marketing year. And of course, once you do that, then that impacts future years too. So, these lower prices are going to help bring back in some feed demand. I think we're going to start rebuilding the herd, but it might take a while before we start seeing that come in, or, it will take a while before we start seeing those numbers show up in the cattle on feed report. But to me, that just strikes as a multi-year bearish factor to the corn market that I think is going to be hanging out there for a while. The other thing, just one other point for the grain stocks report before we maybe talk something else, but the other thing that stood out to me as being impactful was the size of the on-farm stocks. And there's been a lot of people talk about this, but depending on your commodity, the on-farm stocks year over year increased anywhere between 30 and 40%. And we believe a lot of those stocks are unsold. And so if there is any type of rally, farmers are going to get aggressive in their selling and offload some of those grain stocks, especially in the corn and the wheat markets. And that'll help put a lid on that grain market.
Rally.
Yeah, it'll kind of help tamper that rally. So, I would say that if we get a couple weeks here into July, past pollination into grain fill, I think farmers are going to start unloading that grain anyways, and that'll be a bearish sign to the cash market.
Well, and it's kind of interesting just looking how that report itself stacked up. So it like you said, it puts that lid on that intermediate maybe potential for corn to really move higher. But and going back to what you said about the overall capacity that farmers are just holding on the farm. So you got to think about their balance sheets and the price that they're paying, the potential loss that they could be taking just storing that grain. So any chance to offload that you think would get, dumped on pretty quickly. And like you said, that miniature rally could be very short lived. But looking ahead, into some other areas, looking into the acreage report, were there any surprises to you within that acreage report when we see, a lot of these things above trade estimates or pre-report estimates rather?
Yeah, so that corn acreage number for 2024 corn came in 91.5 million acres, or just shy of 91.5 million acres. That was up 1.4 million acres from the March planting intentions. Also up 1.1 or a little over 1.1 from where traders had expected heading into the report. However, you and I had talked about this last week about how I felt that the market was really trading a number closer to 91.2, 91.3 million acres. And I'm going to stay by that because I actually think the way the corn market closed on Friday signaled to me, and only down 10 cents, but down 10 cents really strikes me as that the trade was trading a 91 and slightly higher national corn acreage number. And so this came in high. It came in pretty close to where I thought we were going to land, just kind of observing around the Cornbelt the last couple of weeks. Of course, people are quick to point out the flooding up in Iowa, Minnesota, North Dakota, Nebraska. All that doesn't get figured into this planted acreage number. Where we could see that impact is in the harvested acreage. And as a reminder, USDA doesn't really adjust those harvested acreage differences till the end of the year. So it could be a while before we start to see that shake out, or at least a lower harvested acre relative to a planting acre. The anticipation, though, is that some of those acres that we lose up in the Iowa and Minnesota, North Dakota, Nebraska, are going to get made up by not as high of abandonment in other areas of the country, namely Kansas, as they recover from drought, and Oklahoma, Texas, places like that. So no, there was some surprises, but I think the corn acreage number was the biggest surprise to everybody. And as you and I had talked, I was anticipating a higher number, so it wasn't all that big of a surprise to me. But certainly adds, you couple that with the grain stocks number,
this added potential.
Well, this added 300 million bushels to the supply side of the balance sheet, and so certainly that adds more cushion to the market.
Yeah. So we've hit on a bunch of supply side things. Maybe looking at the demand side of the equation here, we're seeing some production maybe pull back a little bit on a week to week basis, but pretty level compared to recent history. So looking at U.S. ethanol production, the latest number out of that was 307 million gallons on the week produced, as opposed to 311, the week prior. So a little bit of a drop in that, and we're in the heart of that summer driving season for holiday weekends coming up, things like the 4th of July. So what's your read on kind of the slightly positive but still kind of middling impacts there maybe?
Yeah, so ethanol's been a strong demand use category for corn pretty much all year. We've seen some solid numbers in that corn ethanol grind. The May ethanol grind, the official numbers were very supportive as well. Um, as of now, we're running a little bit higher than where we would need to be to hit kind of our ethanol target for the year. The thing that I would say is this flooding, back to the flooding in Minnesota, Iowa, I keep talking about that region. It is very, it's devastating for producers in that area. And it's I think for a lot of other people, it's confusing why it hasn't had a bigger impact on the market. Well, you have a supply reduction. One of the other things that it impacts is as those rail tracks get flooded, it becomes hard to move product into ethanol facilities. And keep in mind, Iowa and southern Minnesota and Nebraska are large ethanol producing states. But more importantly than getting product into the facility, it's also getting the ethanol outside away from the facility. And when rail tracks get flooded, what tends to happen is the ethanol starts backing up. And since plants pretty much run at pretty efficient capacity, you can only back up ethanol so far before the plants have to shut down. So I look for the next couple of weeks to see that ethanol production number, that weekly production number, decline. Maybe not near as far as what we saw back in February, but certainly I think it'll take a hit here the next couple of weeks, and that'll actually probably put us pretty close to where we need to be for the year on ethanol production. So I think this was maybe a little bit of a bearish tint that's going to impact some basis markets in different areas of the country.
And then, Ben, I just want to touch base real quickly on one more item, and then we get to wind down here. But you've had some written commentary on managed money positions at the CME. So, a near record return to net short position. So a lot of these managed money traders, they have to buy back these positions at some point. And in your commentary, you mentioned that that's not very typical for June, to close out June, that uncertainty of weather and other factors really discomfort, managed firms from doing such behavior. But why might they be more comfortable doing that now than in prior years?
This is the $1 million question in a lot of ways. I've been amazed of how comfortable traders have been at being short, the commodity markets here this summer. We saw a little bit of a short covering rally there in May that allowed wheat and corn contracts and soybean to some extent to move higher there for a period of time. Now we've reversed that, and traders are back moving net shorts week over week. This week, we had almost a little over 86,000 net short positions added to that short position of the Chicago corn contract, and we're getting very close, closer and closer all the time to a record net short in that corn contract, and it's amazing to me that it's coming during the summer, when, as you mentioned, managed money accounts don't like the uncertainty of weather. So they seem very comfortable hanging out there on the net short side. They seem to further think that the market has opportunities to the downside. Of course, if the market started to turn or firm, maybe we got a little bit of a weather scare here in the summer, they're going to buy back, and that's going to exacerbate kind of a little bit of a bullish rally, but that's going to immediately be bet with farmers selling. So I would say that you've kind of got a little bit of a cap and a floor in the corn market, really the feed grade markets, grain, sorghum, wheat, corn, all of them, to where I think they're going to trade in a pretty narrow range for a month or two until we get at least out of the U.S. growing season and into maybe South America planting.
Well, now that you said it's going to stay in that narrow range, there's going to be some major global event that's going to blow that wide open.
Of course, yeah,
Of
that's how
course.
this works.
All right. Well, Ben, looking into the next week or so, what should farmers and ranchers be thinking about in this 4th of July week trading cycle?
Yeah, so it's a shortened week, which thanks to the holiday, we get that day off from the markets on Thursday. Yeah, it's pretty straightforward week. We do get Fridays, what I call the jobs and unemployment report, but it's U.S. unemployment numbers, and then hourly wage reports. The Federal Reserve is going to be watching that report closely because this is kind of the last of the big reports. There's some other reports, but this is the last of the big reports before they meet at the end of the month. They got some supportive inflation data from the PCE last week, and so this one could be another trend that the inflation is softening and that the Fed can start to think about cutting interest rates. And then next Monday, because of the delayed week this week, the CFTC reports will come out on Monday of next week instead of Friday this week. So happy 4th of July to everybody. Be
Happy
safe.
4th of July.
Yeah, be safe, but enjoy the holiday.
All right. Well, if viewers and listeners would like to learn more about us and what we do, or our sister program, the weekly livestock market update, you can check us out at brownfieldagnews.com. Ben, thanks for your knowledge and information on the program. It's always helpful. Everyone, we'll see you next week. I'm Will Robinson on Brownfield.